Here's my disclosure. When we're talking about investments, we're talking about stocks, bonds, mutual funds, which can include indexed and active funds, and exchange traded funds. So just to talk a little about what these are, stocks are ownership in a company. So if you own a stock of, let's say, AT&T, you own a small percentage of that company. Bonds are debt instruments. So if you own an AT&T bond, for example, AT&T owes you money and they want to repay that money. So you have debt in the company. Or mutual funds tend to be either stock mutual funds or bond mutual funds, or a combination thereof. You can have a mutual fund that is a balanced fund per se, that's 60% stocks, 40% bonds. There's approximately 9,000 mutual funds out in the marketplace right now, so there's a lot of mutual funds. Index mutual funds tend to be a way to try to replicate owning an index, and they don't have active managers that try to beat an index. Active mutual funds have a manager whose theory that they're going to be able to pick stocks that can beat their relative benchmark. So if there's a large cap US growth mutual fund, the index that's tied to tends to be the S&P 500. So you can own a mutual fund that just owns the S&P 500, or you can own a mutual fund and pay a manager that thinks they can do better than the passive mutual index can do. And there's also exchange traded funds, or what's called ETFs. ETFs are generally a passive index way to invest in a market, and they tend to be lower cost than mutual funds, and they tend to track better than mutual funds, and they also tend to be more tax efficient than mutual funds. When it comes to evaluating investments, a common evaluation is what level of risk are you taking for the level of return that you're getting. And there's also an asset allocation strategy. And a simple asset allocation strategy is how much money do you have in stocks versus how much money do you have in bonds. And the money you have in stocks, how much of it's domestic, how much of it's international. And you can take it a step further, how much in domestic, how much of it's large cap versus small cap, and how much of that is large cap value versus large cap growth. So asset allocation can start out as a simple topic and can get a lot more complicated if you dive down into it. Another thing about investing is time versus timing. I've never seen a study or saw a manager who could sufficiently time the market. So if you ever work with anybody that their investment experience or their investment expertise is knowing when to get in and out of the market, that is not a strategy that can work. And the last thing is having a strategy. So if you have a written investment policy statement and have a written strategy, you know what you're doing when you're coming to investing versus just hoping what you're doing is going to work out. The next slide, we're going to talk about risk return and asset allocation. This is a picture of what's called the efficient frontier. And that is the assumption that for any given amount of risk a portfolio has, and when it comes to investment basics, risk is measured in standard deviation. So for any amount of risk a portfolio has, there's a given rate of return that can be expected for that risk. There's nothing wrong with a very risky portfolio, but if you have a risky portfolio, you want to make sure you're being compensated for the risk you're taking. Nothing's worse in the investment world to have a risky portfolio that is very volatile in terms of standard deviation, that after 20 years has relatively the same rate of return as a portfolio that did not have the same level of risk. So if you're going to take risk, you want to be compensated for the risk that you take. The efficient frontier also shows that the correlation between a non-risky portfolio and a risky portfolio is not a linear relationship. The next slide will go through some numbers showing that it's not a linear relationship. Here I've added some portfolios, hypothetical portfolios, to the efficient frontier curve. You can see an ultra aggressive growth portfolio has a rate of return of about 10 and a quarter and has a standard deviation of a little over 15. If you go down to a conservative growth portfolio, your rate of return is reduced by about 20%, but your risk level is reduced by about 40%. So for each additional unit of risk you take on a conservative growth to an ultra aggressive growth portfolio, you don't get a linear additional unit of return on that portfolio. There's diminishing returns the riskier you get. The next slide will show the hypothetical allocation of an ultra aggressive growth portfolio. Again, knowing history, you can tell or have an ideal portfolio relative to a risk level. So somebody that wants to be ultra aggressive on their investment portfolio shouldn't go out and just buy one stock of AT&T. They should have a strategy on how they're going to invest that money aggressively, and there is an efficient way of doing it. In this example, you can see the different asset classes that are represented here on a large macro level, because it can be dissected even further than this, but that's an idea of how an asset allocation strategy can be implemented. Once you determine what your asset allocation strategy is, the next step would be, do you want to own mutual funds or ETFs or individual stocks? Or do you want it to be an active managed strategy or a passive managed strategy? But the biggest component of what you're going to do that's going to determine whether or not you're successful in your investing is the asset allocation strategies that's underlying your investment decisions. Now that you have a general idea of what an allocation strategy is, the question is, what do you do to start? You have to figure out, are you going to use an advisor such as myself to help guide you through the investing process, or are you going to do it yourself? And either way, you have to figure out a strategy. Emotional decisions, investor behavior, is the number one cost to an investment portfolio. So you need to have a strategy that's going to remove emotions from investing. Too many people, advisors included, will react to the stock market. So when the stock market is up, people enjoy putting money into it. It's easy to be an investor. When the stock market loses money, a lot of times it can be hard to continue to put money in the market or not have a reaction to make a decision based upon emotions. If you do use an advisor, I want to kind of cover how advisors like me get paid. The first way is fees. The second way is commissions. The third way is both. So commissions on an investment account is when you buy or sell inside the account, there's a commission generated that goes to the advisor. Fees generally are investment advisory fees that are a percent of the assets the advisor has under management. So if you have $100,000 with the advisor, and the fee would generally be 1.5% on that, the advisor gets a portion of that fee to go to them. And no matter how many trades you make or how many investments you make, the fee is the same, as it's based upon the account balance, not the activity in the account. And then both, I've seen some advisors that they'll charge a flat investment advisory fee and commissions or fees on the investment account too. My summary on this is, whether you pay fees or commissions, as long as you understand how the advisor is getting paid, but I don't understand why somebody would pay both to an advisor. So pick one if you're going to use an advisor, and it's perfectly okay to have an upfront conversation with your advisor about how they're going to get paid and how they're going to provide value to you in their investing accounts. The next chart is going to be on the next page, talks about, again, why you want to remove emotion from investing. Here's the markets chart of the day. This shows a $10,000 investment between 1993 and 2013. And if you Google timing versus time in the market, there's a ton of charts like this that come up that talk about missing the best days in the market. So if somebody invested for these 10 years and they were fully invested in the stock market, they'd have about a 9.2% return. If they missed the best 10 days through emotional investing, because when it comes to emotions, what most people would emotionally is they like to pull money out of the market to go to cash, or they change their asset allocation strategy when the market's bad. Then when it gets better, they've lost out on some of the good days when they get back in their investment portfolio. And you can see if you miss the best 60 days over a 10-year time period, the return is actually negative. There's a lot of studies out there by Dalbar, which is one of the industry leading research firms, that talks about the impact of investors making bad decisions. You can Google Dalbar, Dalbar, and see their results. That's one of the big reasons I think that it makes sense to use an advisor, is to help control the emotional investing that a chart like this proves happens over and over again to an individual that does investing. On this slide, there's certain things that you can control in an investment portfolio, and there's certain things that you can't control. So the things that you can control are, what are the fees that you're paying? Whether you're in an advisor account, which fees will be higher than doing it by yourself, or if you're in an account by yourself, there's always going to be fees when you're investing. You want to know what those fees are and what you're getting for those fees. The next thing that you can control is risk level. This comes back again to an asset allocation strategy. You can control whether your portfolio is 100% in equities or 100% in cash or a combination along that scale. You can also, to some degree, control the income and taxes that are generated on a portfolio. The thing that you cannot control is performance. If you're investing with the best asset allocation strategy you can have, and the market just happens to perform poorly in that given time period that you're investing, there's not a lot you're going to be able to control on that, as you're probably going to lose money when the market's going down, and you're going to make a lot of money when the market's going up. The main thing to think about is a long-term investing perspective. The longer you're in the market, the less the yearly, quarterly, or daily fluctuations will affect your portfolio. In summary, when you're doing investing, number one thing is you want to have a strategy. And that largely ties back to an investment policy statement and an asset allocation strategy. So what an investment policy statement is basically having a strategy, having it laid out why you're invested in what you're investing, how you invested in what you're going to invest, how often you're going to rebalance the account, and what the goals of the account are. Once you have a strategy and you have it written down, keep long-term perspective on investing. There's going to be more volatility in the market than most people realize is involved in investing in the market. If you have any questions on this presentation or any of the other ones I've done, feel free to give me a call or an email, or I'll see you at one of the question and answer sessions